The biggest order quarter in Saab's history, 68.4 billion Swedish kronor in bookings, up 141%. And the division driving it, the naval business, actually made less money.
Wait. The part booking the record contract lost margin?
Naval EBIT fell 14% year-on-year. Same quarter, it took in 52 billion kronor of naval orders. The record intake and the weakest margin in the fastest-growing division. Same 3 months.
That's the whole tension right there, isn't it?
That's the whole game for Saab now. Winning the orders was the easy part.
So, set the scene. What did Saab actually report on the 17th?
A blowout on almost every top-line measure. Bookings up 141%. Backlog at 318 billion kronor. A year ago, it was about 198. Organic sales up nearly 30%. EBIT up 41%. Margin ticked from 10 to 11%. And cash flow flipped, positive by more than $1 billion in the first half, versus a $1.1 billion outflow the year before.
And the single thing that moved the backlog?
Poland. A 47 billion kronor contract for A-26 submarines. The CEO called it the largest export order in Saab's naval history. There's also a Gripen E fighter deal for Ukraine, about 24.6 billion, that Saab expects to book in the third quarter. Note the tense, expected, not booked.
And the backdrop is the rearmament story everyone's been talking about since 2022.
The European Defense Agency reported it the day before Saab's results. EU defense spending hit 418 billion euros in 2025, up 20%, and 23 of 27 member states are now at or above the 2% of GDP mark. Budgets are up 47% since 2022. Brussels has also put 150 billion euros of cheap loans on the table for joint buying and relaxed the fiscal rules. Saab is catching that wave at exactly the right moment.
Back to that margin drop. Why does winning the biggest order in your history make your division less profitable?
Two things hit the profit and loss at once. First, the capacity expansion. To build submarines for Poland, Saab is expanding 2 Swedish yards, Karlskrona and Landskrona. That's money going out before revenue comes in. Second, there was a write-down on a Swedish domestic frigate program, about 200 million kronor. So, you're spending to grow and eating a charge on an existing program in the same quarter.
But that's a one-time thing, right? Expansion costs take the hit, move on.
Maybe. Here's what makes it more than 1 quarter of noise. Management says roughly 60% of that 318 billion backlog is deliverable within 2.5 years. That compresses the whole thing into the near term. So the question isn't, can they eventually build it? It's, can they stand up the physical capacity fast enough to deliver most of the book by roughly the end of 2028 without the margins sliding further?
And if the yards aren't ready on schedule?
Then the delivery window slips against a fixed backlog, and revenue recognition gets pushed right. The record book only converts to cash on the factory floor. The frigate write-it-down is the tell to watch. If it expands beyond that 200 million, it means domestic naval work and export contracts are fighting over the same scarce welders and engineers.
You mentioned the Ukraine Gripen deal isn't booked yet. Why does that matter beyond the accounting?
Because of when it lands. If that 24.6 billion fighter contract books in the third quarter as planned, it drops onto a company already straining to expand naval capacity. Gripen is built by a different division, aeronautics, but skilled defense manufacturing labor in Sweden isn't infinite. If the fighter program and the submarine program are both ramping at once, Saab has to triage between its 2 largest sovereign customers.
What's actually holding up the booking?
The record doesn't fully pin that down. The open question is, what European financing mechanism underwrites Ukraine's purchase, whether it's insulated from any single government's budget cycle or a political reversal? There's the Commission's joint procurement instrument, but whether it's specifically backstopping this deal, the record doesn't confirm. So the third quarter booking is the signal. If it slips, that's political or financing friction showing up.
And Poland's sitting on the other side of the same capacity crunch.
That's the sharp irony. Poland is locked into a supplier that's under financial pressure precisely because of the expansion needed to build Poland's own submarines. The key question for Warsaw is whether that contract has enforceable delivery milestones tied to Karlskrona and Landskrona readiness. And if not, what leverage Poland holds if the ramp slips. The playbook there is the F-35 model. Demand technology transfer, co-production, build domestic content with the Polish State Defense Group so you're not fully hostage to 1 yard's throughput.
Saab is one company. Who else does this reach?
Start with the fastest moving. European institutional investors. This is the clearest earnings proof the rearmament trade is real, not a pledge. 141% order growth, 41% EBIT, positive cash flow.
The trade everyone piled into.
Right. Next, the Swedish government faces a direct call. How much public money to put behind Saab's production ramp so the export orders actually deliver? Then the defense supply chain. Submarine-grade steel, marine electronics, sonar, precision machining. Demand for all of it jumps as 2 yards expand at once. Then, sovereign wealth funds and long-duration allocators, who read this as confirmation defense is a multi-year theme, not a spike.
And the alliance-level players.
NATO. This is evidence its pressure on European members turned budget pledges into real contracts. U.S. defense contractors, the other side of that coin. Poland's submarines and Ukraine's fighters are European procurement going to a European supplier, in categories where Lockheed and others would normally compete. And defense sector debt markets watching Saab's improved cash. Net liquidity of 2.5 billion kronor, which reprices how safely you can lend to the sector.
The US one surprises me. That's real market share moving.
In capability categories they'd expect to own. It's a quiet structural shift underneath the spending numbers.
Where's the record genuinely thin?
3 places. 1. The financing behind Ukraine's Gripen deal. We don't know which mechanism underwrites it or whether it survives a political reversal. 2. Whether Poland's contract has real delivery penalties tied to facility readiness, or whether Poland is exposed if Saab slips. 3. Whether Saab's double win, growth and margin together, is sector-wide or a Saab outlier. The other primes hadn't all reported when this landed.
And the frigate write-down. Is that the floor or the first of several?
Unknown. 200 million taken. A second charge would tell you domestic and export work are competing for the same labor. That's a number to watch.
So what tells us which way this breaks?
First, the third quarter results. Does the Ukraine Gripen booking actually land? Delay is the primary signal of financing or political trouble. Second, any guidance update on the Karlskrona and Landskrona timelines? A slip there compresses the delivery window directly. Third, whether that frigate write-down grows. And fourth, the other primes quarters, Rheinmetall, BAE, Thales, Leonardo.
Because of what happened to Rheinmetall.
A German frigate program cancellation the week before triggered a sell-off. Same rising sector, and sentiment turned on execution overnight. McKinsey pegs European platform fragmentation at more than 4 times the US level. Labor shortages, supply bottlenecks. The boom is splitting into execution winners and losers faster than the uniform stock gains since 2022 suggest. Saab won the orders every rival wants. Whether that backlog becomes profit depends entirely on 2 Swedish shipyards it hasn't finished building yet.
This episode is grounded in a world-by-flow analysis, drawing on 17 web sources.